Stablecoins are designed to be stable, but that stability is only as strong as the issuer behind them. Unlike Bitcoin or Ether, stablecoins don't rely purely on decentralized market forces. They depend on trust and reserves, custody, and governance. As a result, issuer quality is a key risk variable in the stablecoin ecosystem. The first major consideration is counterparty and custody risk. Stablecoins are typically backed by cash, U.S. treasuries, or other liquid assets held with banks and custodians. If a counterparty fails, or if reserves are mismanaged, the peg can come under pressure. History has shown that transparency gaps and concentration risk can quickly undermine confidence. Second is liquidity risk. Stablecoins must be redeemable at scale, especially during periods of market stress. If reserves aren't sufficiently liquid or well matched to potential redemptions, forced selling can amplify instability. The ability to meet redemptions in real time is what separates resilient stablecoins from fragile ones. Third is regulatory and compliance risk. As stablecoins grow into systemic payment infrastructure, they attract increased regulatory scrutiny. Issuers face evolving rules around reserve composition, disclosures, and consumer protections. Uncertainty, or non-compliance, can disrupt operations, limit access to banking partners, or constrain growth. Importantly, these risks are not theoretical, they're structural. And that's why issuer behavior matters so much. Higher quality issuers typically seek to mitigate these risks through a combination of conservative reserve management, emphasizing cash and short-dated U.S. treasuries, regular independent attestations and audits to build transparency, robust banking and custody relationships to reduce concentration risk, and ongoing regulatory engagement aligned with existing financial safeguards. The key takeaway is that stablecoins don't eliminate trust, they reallocate it. Investors and users aren't taking a view on price appreciation, they're placing confidence in issuer discipline. As stablecoins scale, the market is likely to differentiate them less by brand or yield, but by the strength, transparency, and credibility of the issuer behind each token.